In this month's video, I'll discuss some of the major headlines that influence markets in February. I will also provide insight into what these developments could mean to you as an investor. Please stay tuned at the end of the video for a required disclosure statement. Domestic markets started 2018 with their best monthly performance since at least 2016, only to stumble in February. Both the S&P 500 and the Dow had their first monthly losses in 10 months, breaking their longest winning streak since 1959. Overall, the S&P 500 lost 3.9%, the Dow dropped back 4.3%, and the Nasdaq gave back 1.9%. These losses came as volatility picked up throughout the month. In early February, we experienced back-to-back stock sell-offs followed by large jumps. During 1 week, the Dow lost 1,000 points and gained 300 back twice. But this volatility wasn't the result of negative economic data or geopolitical problems. Instead, a combination of emotional investing and computer-generated trading may be to blame. Essentially, investors became concerned about inflation when the labor report indicated wage growth was picking up. In other economic news, we received a variety of positive and negative reports. The most recent data for the housing showed both new and existing home sales dropped in January. Housing starts, on the other hand, hit their second highest rate since the recession. We also received the second reading of fourth quarter GDP at 2.5%. The growth matched expectations. Ultimately, though, worry about inflation and the resulting potential for interest rate hikes contributed to much of the month's volatility. By the end of February, comments from new Fed Chair Jerome Powell led some investors to believe interest rates may in fact rise faster than anticipated. In testimony to the House Financial Services Committee, Powell spoke of growing global strength and stimulative fiscal policy. He also said that inflation may be moving closer to the Fed's target rate. This positive view of the economy could potentially result in 4 interest rate increases in 2018. On February 27th, stocks dropped significantly in response to Powell's testimony. The volatility continued the next day as stocks whipped back and forth before ultimately ending down. If February's volatility feels unnerving, that may be the market's unusual calm in 2017. Since 1980, the average annual S&P 500 correction has been approximately 14%. Last year, however, stocks only fluctuated 3%. Considering last month's fluctuations, remember that positive economic perspectives were behind much of the movement. Despite the volatility, consumer confidence easily beat expectations and showed that people feel particularly good about the labor market. Jobless claims supported this perspective as new employment filings remain near historical lows. Moving into March, we will pay attention to inflation, interest rates, and investor behavior. On March 21st, the Fed may raise interest rates again and provide greater insight into their expectation for the year ahead. As developments arise, we will keep you informed. That's it for this month's Educational Economic Update. Once again, this is Mark Ruiz with Oak Partners signing off for the month of March 2018. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 219-795-1000. We'd be happy to talk to you. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal, and no investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. Thanks for tuning in.